Well, Canada's financial regulator wants the country's big banks to have more of a financial safety net in case borrowers can't pay back their loans. The Office of the Superintendent of Financial Institutions also noted today that about 12% of borrowers of uninsured mortgages, so mortgages that are fully on the bank's books, are only covering interest payments. So the borrowers are not paying anything towards their principal. Some aren't even covering the entire interest payment. The excess is just being tacked back onto the loan, known as negative amortization. The regulator wants banks to have more capital available in case some of those loans go bad. Joining us now is Ing-Haw Cheng, Associate Professor of Finance at the University of Toronto's Rotman School of Management. Thanks so much for making time for us today.
Thank you.
So what do you make of OSFI's move here, the banking regulator's move here, to get the banks to have, more capital available in case, of a worst case scenario here?
So I think it's a prudent move by OSFI to ensure that banks, if the housing market does, if borrowers are unable to make payments in the future, that the banks are sufficiently well capitalized and safe. Essentially, what OSFI has done is raise the capital requirements for banks, and banks now have to have more capital to protect against potential future loan losses from the residential mortgage market.
I mentioned the uninsured mortgages, but many mortgages in Canada are insured. If you're putting down a down payment of less than 20%, then you're getting insurance on that mortgage.
I think right now OSFI is, and this regulation and the concerns are very much focused on the uninsured mortgage part, potentially because essentially amortizations are capped at 25 years for insured mortgages, whereas uninsured mortgages amortizations can be even longer. And right now, several of those mortgages, as you noted, are entering into negative amortization territory, where interest rates have gone up sufficiently so that not only are borrowers only paying interest, but they're not even paying enough interest so that the difference is being tacked back onto the principal payment. So even though borrowers are making payments, the amount they owe is going up. And that presents a situation for banks where they have to assess whether or not, at the end of the day, are the borrowers going to be able to make the new pay off the loan? Are they now greater credit risk?
Right. I mean, because it could be quite a shock to the system if your 3 or 5 year term, what have you, ends, and then you actually have more principal to pay down, or more mortgage to pay down, because that interest has just been adding on to it. So you're refinancing, but potentially a bigger amount.
That's right. So here in Canada, given that we only have mortgage contracts that last, typically, let's say 5, maybe 10 years at the most, a lot of borrowers may be facing a situation where when their mortgage terms renew, they face higher payments given the negative amortization structure that they're facing right now. And that could present a big shock for many borrowers, to be honest. And the banks, from the bank side, they have to make sure that they're protected, right? And part of the capital regulation that OSFI is promulgated today is intended to make sure that the banks are sufficiently well capitalized in the event that occurs.
And we've heard from some saying that this is a short-term thing. These long-term amortizations, it's a short-term solution, or a sort of a Band-Aid, I suppose you could say, to get through this period. Not something that is intended to be a forever model. But are there risks? I mean, yes, to the individual who might, have a challenge when they go to refinance. But, with extending things, the amortization length being longer, could people also get used to that? And all of a sudden we start to see our system sort of shift?
Well, it's definitely, if you take it from the borrower's perspective, you're essentially taking out a longer loan because your current payments are not sufficient enough to pay down principal. And if you were initially stretched to begin with on the terms of the loan that you took out, now you're actually, in some sense, becoming even more stretched, right? Because the amount that you owe is going up in a higher interest rate environment, so that when you renew your mortgage contract, you might actually not only face a greater principal balance, but now a greater interest rate, and your payments might be much higher. So I think it presents a significant risk to borrowers. And that risk, of course, credit risk, the banks who now have to worry, gee, can these borrowers essentially afford the larger loan balances that they're now stuck with? There's a term for this, which is like extend and pretend, right? I mean, that's like the industry jargon. Are we just pretending at this point that the borrowers who are tacking onto their principal can actually pay off the loan?
Is pretending, at least in the short term, though? I mean, though there can be those longer term costs to it. Can it be worth it, to make sure that people are staying in their homes and they're not, getting to that point where they're, forced to do something that they wouldn't otherwise have wanted to do?
Yeah, absolutely. I mean, I think, the hope right now, if you're one of the borrowers, is that interest rates come down, right? If interest rates come down, then you're back into a safer territory, shall we say, where your interest payments will now go back to paying down principal. And if that happens in the near term, then you'll have stayed in your house and you'll have actually benefited from that in that sense.
So should the regulator, from your perspective, should it target these amortizations, or is going this route through the banks of saying you need to have capital aside just in case the better way to go?
I think the regulator's in a difficult spot because, of course, we want people to hopefully not experience too much disruption in their lives. But at the end of the day, you don't want to saddle the banks with, a bunch of bad loans that come home to roost later. And that, because if you do that, you risk the stability of the banking system. If loan losses really accumulate on banks' balance sheets, Canada's banks have historically proven to be extremely safe and extremely resilient. But I think part of that owes to regulators like OSFI being cautious with the banks and telling the banks, hey, you got to shore up capital because there are a lot of risks on your balance sheet.